Broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. I just want to say hello to all our wonderful subscribers and welcome to today's Department Store Executive Review webinar. This is Michael Blackburn, and also on the call today we have Jim Rice and Emily Manley. So as usual, we're going to go through, first start with some sector trends and then go into specific data with a spotlight on a few key accounts, Kohl's, Nordstrom, and Burlington Stores. As usual, if anyone has any questions, feel free to type them in and we'll try to address them as we go along. And at the end of the discussion, we will have time for Q&A as well. So starting off with the department store sector trends, the overall environment is one of increasing uncertainty, right? I mean, we're dealing with high inflation, rising interest rates. We have the debt ceiling crisis, which we think a deal would be approved by Congress and the president today. There's been stories about failing banks, rising loan defaults, and all this leading to a weakening consumer outlook and economic position. So the U.S. consumer spending binge that occurred during the pandemic is collapsing, and the department store sector was one of the first to show signs of this. Entering 2022, retailers were still struggling with supply challenges, and in response, most took pretty aggressive approaches to inventory, buying early and increasing purchases to avoid repeating the 2021 stockouts that they had to deal with. But then, as inventory levels ballooned, we saw consumers shift their spending away from discretionary goods as budgets were stressed by higher price essentials, while some spending also shifted back to the service sector. For fiscal year 2022, comps began to turn negative while margins and profits took a hit from heavy markdowns to clear out the excess inventory, which continued through January as most companies looked to enter the fiscal 2023 with a stronger balance sheet. The charts on the right here show this impact with comps down an average 1.2% last year, although I do want to warn that we have limited comp data, particularly in 2020, 21, and 2020 itself due to the pandemic. Actually for 2021, we only had two companies reporting comps. Most companies decided we really don't have comparable periods due to the pandemic and did not disclose those numbers in those past 2 years. Most have now starting to put their comp numbers back onto their earnings reports. But then looking at the EBITDA margin in 2022, we saw margin levels largely below pre-pandemic levels across the board to a large extent due to the declining sale trends and the hit to the gross margin due to all the promotions and clearance activity. Looking at sales so far in 2023, using the U.S. Census data, which reports retail sales, we strip out the department store numbers. Sales declined over 1% in both April and March. And we're down 1.4% in April year over year. So negative numbers continued into the 2022 period. Retail apparel saw a similar trend so far this year as well. So after this pandemic-fueled spending binge and the lingering high inflation and other macro headwinds, we're all pretty well versed on how consumers are cutting spending on discretionary goods. The question is, how long will demand for discretionary goods fall? Is this a short or long-term trend? And when or will department store retailers start to restock their inventory levels? Much to this answer is wrapped up with our overall economic trends. And while we seem to have avoided a technical recession, the risk of a recession remains, and arguably half the country, the lower income half, has already been in a recession for months. A recent survey I read in the Wall Street Journal said over 50% of consumers are switching to cheaper brands, and 90 million households are struggling to pay typical home expenses, so just their essentials. Meanwhile, credit card balances have grown to historical highs at a time when interest rates are also on the rise. So in this environment, we're seeing the most pressure being felt among chains focused on those lower and middle income consumers. So you have your JCPenney's, your Belk, your Kohl's, and even Macy's. On the apparel side, you have Gap, Old Navy, and H&M. They're the ones most exposed. Now, for the high end, the luxury end, they had seen a lot more resilient performance in 2022, but we're now starting to see sales drop there as well. And also in response, a focus on cost cutting as these companies try to weather the storm as well. As for when will ordering increase, the evidence so far indicates it's still down. Looking at container imports on the U.S. West Coast from Asia, those declined about 23% in the first quarter from the year earlier, according to a data company called Descartes Data Mind. Meanwhile, there's the post-pandemic push to kind of rebuild supply chains with a focus on regionalization, with production closer to our shores. So the onshoring and nearshoring of manufacturing. Companies are focused on that. And the key there is the efforts to make supply chains more resistant to disruption, the issues we had during the pandemic. So moving away from the last 30 years of model built on scale and efficiencies, the so-called just-in-time systems, shifting to what we might call a just-in-case system. Obviously, though, this is adding costs. And further, most companies are still trying to figure out how to handle this transition, so it hasn't really hit too significantly yet. Looking at capital spending, store growth has been pretty limited outside of the off-price and specialty formats, but the good news is closures have, for the most part, slowed. Most CapEx spending is still focused on building better omni-channel platforms and all things digital, including more targeted pricing, promotions, and loyalty programs. Looking at online sales, though, we've had some recent issues, and obviously the biggest one being how do you fix costly returns, the extra costs for dealing with all the returns that happen with online sales. And we're starting to see some changes here, things like charges for returns from some retailers. We've got introduction of tiered pricing or lower pricing for those without return options. Even Amazon, which set the tone for fast, free returns, they're starting to dial back here as well. Meanwhile, we're continuing to see the shift, the off-mall shift, specifically relocations away from lower quality malls. Also, the ongoing experimentation with small and value formats. Examples here could be Market by Macy's and Bloomie's, or even Belk's new outlet conversions for some of their underperforming locations. Other issues we've seen are significant C-suite turnover in recent years, whether they are struggling performers like Kohl's or companies that have maybe weathered the storm a little bit better, like the pending retirement of Macy's CEO Jeff Gennett. Another issue has been shrink. That's still a big issue. The National Retail Foundation said that shrink grew by $4 billion in 2021 to $95 billion. And arguments are that continued in 2022. In recent one-quarter earning calls in the last month, retailers including Target, Dollar Tree, Home Depot, TJ Maxx, Kohl's, and Foot Locker all called out shrink as a reason behind why their gross margins took a hit. Walmart specifically said that theft remains historically high, and if it's not corrected, prices will rise and stores will close in certain markets. The question I have in addition to store closures is if this is really if this isn't rectified soon, will it continue to accelerate the e-commerce shift that we've been experiencing? Some of the reasons are behind the increasing shrink and that trend, particularly among organized crime, has been the growth of reselling markets, which makes it easier to offload these goods, particularly online resellers. There's obviously also been some law changes reducing penalty for low-risk offense. So to summarize, in this market environment, all department store retailers need to sharpen their value offering and their clearance selling, maintain a strong private brand offering, and continue to invest in a strong omni-channel platform, while also focusing on cutting those non-essential costs. With that, I'm going to turn it over to Jim, who's going to talk about our first slide on sales.
All right, thanks, Mike. As Mike mentioned, there's been a slowdown in discretionary spending that's really hit the department store sector, at least the traditional department store sector. You can see the sales numbers here are down slightly from last year, and in many cases down pretty dramatically. In Kohl's case, it's one of our spotlight accounts. I would highlight Dillard's success here. Dillard's has done very, very well. People keep asking, what's the secret sauce? What are they doing right? It looks like just blocking and tackling, getting the right merchandise in, keeping inventory levels in line, and charging the right prices. Dillard's is over $1 billion in cash at the end of the first quarter, despite their comps declining 4%. And that's on top of very aggressive share repurchase and dividend programs. They've actually had 2 special dividends in the last year or so. So hats off to Dillard's for doing things right. The rest of the sector struggling a little bit sales-wise. And as I said, discretionary spending is slowing. Macy's called out today on their conference call and said that discretionary spending slowed significantly at the end of the first quarter, and that's continued into the early second quarter. So some real concerns about what's going to happen with the consumer, as Mike was discussing, and how this is going to play out for the rest of the year. And retailers continue to buy very conservatively on the traditional department store side. And Mike also mentioned luxury is starting to slow, had been very, very strong. A report came out today that luxury consumers are shifting their spending to travel and bulking their savings back up again and getting away from apparel and those type of purchases. So the whole sector on the traditional side is feeling that, but Emily can tell you it's a little bit different on the off-price side.
Yeah, thanks, Jim. So looking at the off-price players, we've got TJ Maxx, Ross, and Burlington. And you can see that TJ Maxx is the only company that's turned in year-over-year sales growth. Their sales were up about 3%, while Ross was down about 1%, just in line with the department store average. And then you've got Burlington, which was the anomaly here, down about 7%. Ross and Burlington, the explanation for the decline can be mainly pointed to the fact that they're exposed to a more mid to lower income consumer. And those consumers have been impacted more by those inflationary pressures that Mike talked about. Burlington, down 7%. They were really the outlier here. So they had some serious inventory missteps during the year. And they also had a pretty poor pricing strategy. They claim to have corrected this. So we'll see their 1Q results were better than their fiscal year. So we'll talk more to Burlington. They expect their sales to be up 12 to 14% this year. And that's much higher than Ross and TJ Maxx, which are expecting low to mid-single digit increases. So we'll talk to Burlington when we get to the spotlight slide. And if you guys have any questions, please chime in.
Kind of shows you the strength of the off-price sector, because when times are good, they have the treasure hunt aspect of shopping that appeals to consumers. And then when the economy slumps, they have the value proposition. So it kind of works in both economies, which is why so many people are anxious to get into that sector. Which brings us to the store count. So we talked about large scale closures in the traditional department store sector are pretty much done with. We're seeing more closures on a case-by-case basis, mostly department stores closing in C and D malls. A and B malls are still pretty solid. If you remember, Macy's was going to close 120 stores and then kind of scale that back. And I think we've talked about it, but it's interesting that when Macy's closed a store in a market, they found that online sales decreased dramatically because of the omni-channel impact. Consumers had no place to return merchandise. So Macy's became much more judicious about store closures. And the openings in the traditional sector, and I think Mike mentioned this, are more around specialty stores and smaller locations. Macy's is opening Market by Macy's and Bloomie's. They're going very slowly with it, but they're going into markets where they've closed stores. They're also opening off-price. Macy's Backstage, both store-in-store and standalone stores, there's significant expansion there. Nordstrom opening, being very aggressive with off-price Nordstrom rack openings. And most of the openings are all off mall also. So we're seeing a shift from C&D malls into off mall locations by the traditional department stores and into smaller locations. Kohl's was going to open 100 35,000 foot smaller stores over the next several years. With new management in place, that might be off the board a little bit. And Mike will talk about that when we go through the Kohl's spotlight. As Mike mentioned, Belk opened 16 outlet stores, some of the weaker performing locations. At this point, Belk is taking a pause on that and see how that works. But that could be another trend, is again, a lot of the department stores looking to go into off-price. Von Maur is opening a lot of specialty stores, expanding dry goods pretty rapidly. And Von Maur and Boscov's are both opening a store here and there, regional chains. They're doing fairly well, and opening one-off locations because there's a lot of opportunities available. Dillard's, which has closed underperforming stores on a pretty consistent basis, has a couple of openings planned and continues to close stores that they feel aren't performing well. The real expansion is on the off-price side, as Emily can speak to.
Yeah, thanks, Jim. Off-price, as they have for the past few years, has continued to expand their real estate footprint. TJ Maxx opened the most, about 150 stores, and they expect to do about the same this year. The majority of those will be located in the US, and it's split pretty evenly between their Marmaxx banners, which are TJ Maxx and Marshalls, and then their Home Goods banners. And they've got about 20 stores in the Sierra banner opening. Ross opened about 92 net new stores. Again, they expect to do the same this year. And then we've got Burlington. They opened almost 90 new stores, and that's net of closures. And they've been focused on closing their larger format stores, which are usually about 100,000 square feet or up to that size. And they've been focused on opening those smaller, more profitable 25,000 square foot stores. So that's the avenue that they've been taking. They expect to open about 70 to 80 net new stores this year. And they've mentioned that because of real estate supply issues, they've shifted some of their openings back a year or two, but they expect to continue opening that 500 to 600 stores in the next 5 years. So off-price will continue to expand, and that's no surprise here.
One of the big issues may be there's not enough locations with supply chain issues and new shopping centers really not being built. There may be a scarcity of locations going forward. So real estate's at a premium right now. So I want to mention Burlington's getting fairly aggressive with closing some of their larger stores, trying to get down to their 25,000 square foot prototype, which is a lot more productive. They have some really large legacy stores, some even over 100,000 square feet. And Bells in Florida is really expanding their off-price division. They've recently changed their names from Bells Outlet to just Bells, and they're rebranding the Burke's outlet stores into Bells. So a lot of department stores moving into off-price.
Yeah, and also I'll just touch on the fact the real estate supply. So we've got Bed Bath & Beyond. Those closures will be a big opportunity for the off-price retailers to jump into.
Yeah, there's a lot of competition for some of those Bed Bath & Beyond stores.
I'm sure.
As Mike mentioned, a lot of companies haven't reported comps or didn't during the pandemic and shortly thereafter. So this was always one of our key metrics. And because of the anomalies of the last few years, not as meaningful. And you can see how strong 2022 was for retail, with Macy's almost a 43% comp increase, and HBCX, which was mostly Saks, almost 55%. So, going against some weak comparisons, and 2022 21 was a very, very strong year in retail. So that there were some real strong numbers. So we won't spend too much time on comps just because of the reporting issues and some of the anomalies due to the pandemic. Emily, you have any comments?
No, the comps are pretty much in line with sales there for the off-price.
So with sales expected to struggle, retailers are concentrating on gross margin and trying to improve gross margin. 2021 was a very strong year. A lot of department stores reported record gross margin, and a lot of it was due to supply chain. And sometimes retailers can be their own worst enemy, and they over inventory. With the struggle getting inventory in 21, retailers were forced to be lean and went into the holidays with very lean inventories, as they had said, difficult getting inventory. So record high gross margins. And going into 22, inventory challenges remained, doing everything they can to get inventory in, and the supply chain eased, and almost all retailers in here got over inventoried. And then we saw markdowns to try to align inventory levels with sales as sales started to slow at the same time. So we're going to more normalized times. Retailers are very sharply focused on keeping inventory levels in line. As Mike mentioned, supply chain has eased, and the costs have come way, way down. So that's going to be a big tailwind for retailers on the gross margin side. So keeping inventory levels lean to keep gross margin up so don't have to mark down, shipping costs way down. The headwind is going to be the shrinkage issue, which many retailers have talked about, becoming an increasing problem. So I think local authorities and local law enforcement are going to have to come up, and retailers are going to have to come up with some kind of plan to combat this, because it's just been getting worse and worse, and it's affecting all the retailers in the sector. So despite the expected weaker sales, retailers are pretty confident here they can keep margins higher than they were towards the end of last year when they had a markdown because of excess inventory.
Just kind of a quick update on the Hudson Bay brick and mortar business. We did get some preliminary numbers. We're still waiting on the full fiscal year numbers. And their full year results were down 5%, which would indicate that the fourth quarter sales were negative. And then they also pointed out that gross margin was down over 100 basis points at all three of their banners. So they saw pressure there as well. And then the Saks.com numbers, we just got an update on that. Similar margin erosion was experienced there as well. So, and that's even more concerning because they were generating negative, earnings historically, and now they're even under more pressure.
So on the SGA side, obviously retailers are expecting lower sales. Are trying to keep costs in line. Generally done a good job with that. We see some deleveraging because of the lower sales. And the other issue here is labor costs, which have gone way up. We had the labor shortage for a while. Retailers were having a lot of trouble attracting employees, had to raise minimum wage pretty significantly, and have had trouble retaining employees as well. So that's been an ongoing push, and it's been pushing up expenses. And retailers are struggling with that, especially on the department store side, where one of their competitive advantages is customer service. So the ability to attract and retain, good employees is really important on the luxury and the higher end on department store side. I know many of you have probably experienced walking around the department store and trying to find one of the employees of the store to check you out or have a question, and many times it's difficult to find. But retailers are laser focused right now on keeping expenses other than payroll, what they can control, because of the expectation of the lower sales. Emily,
Yeah,
anything?
and as you can see, the Burlington SG&A is elevated. They've been struggling with elevated SG&A for a little while. So they've got their Burlington 2.0 strategy that they've been trying to work on their merchandising and improving relationships with vendors. So they're looking to get that down and help boost their profitability.
And the Saks.com was chasing sales and trying to build their customer base up. And customer acquisition is very expensive right now on the .com side, and that really put their expenses up significantly higher.
But they are also focusing now on the cost side of the business. So they've been doing some layoffs, and they realize sales are softening, so they've got to cut costs where they can.
Right. So you get sales, gross margin, SG&A, and you get down to EBITDA and EBITDA margin. We like to see on the sector 10% or above, and you could see the tremendous success that we talked about with Dillard's, running 19, 20% EBITDA margin, which is super strong. Penny's faltered a little bit as their sales slowed down in the second half of last year, still above where they were pre-pandemic and pre-bankruptcy. But, that 9.2% they achieved in 2021 is closer to where they want to be. Nordstrom has been struggling a little bit with merchandising. It's one of the spotlight accounts. We'll get into that later. We've discussed HBC and Saks, and strong numbers in the departments in the off-price sector, Emily.
Yeah, so Ross continued to lead the off-price sector at about 13.4%. And TJ Maxx followed with 11.3%. They continue to, have their sales increase help trickle down to the EBITDA. Burlington, however, struggled with their SG&A and also their lower sales. So as you can see, that sharp decline from the 11% down to 7.8%. So they're looking to get that back up there, and we'll see if they can do that in 2023.
And Kohl's historically did, 13 to 15 to 16% EBITDA margin, and struggled last year. And I believe that's our first spotlight account. So let's turn it over to Mike.
Right. Yeah. So as we've been covering, Kohl's has been, struggling, and they had a very difficult 2022. Had to deal with issues on multiple fronts, from declining operations, activist investor pressure, forcing a proxy battle, a failed merger, executive turnover. So in the end, we cut their credit rating from a B2 in 2021 to its current D1 rating. So operationally, they struggled to distinguish themselves from their competitors, kind of with a muddled strategy that left its stores with excess, slow-moving goods and cluttered stores. Fiscal year 2022 comps fell almost 7%. Gross margin was down 490 basis points, or almost 5%. EBITDA dropped almost 60%, or 780 basis points, to just 6.1% margin. I mentioned the elevated inventory issues throughout the sector, but Kohl's was arguably more effective than the average department store. That forced management to sacrifice margin, particularly in the second half, to clear out that inventory. And ultimately, gross margin is now down 300 basis points from the pre-pandemic level, and EBITDA margin is down about 600 basis points, again to that 6.1 level in fiscal year 2022. The lower earnings, increased capital expenditures, and working capital investments, that resulted in them burning $544 million in cash flow in 2022. The CapEx was up on the Sephora rollout, which I'll come back to in a second. Cash, which fell by over $1.4 billion during the year, was further depleted as Kohl's returned $900 million to shareholders, including $660 million in share repurchases and $240 million in dividends. Thankfully, though, the share repurchases were paused in the fourth quarter period, although they continue to pay a dividend. Debt levels were also higher, and as a result, debt to EBITDA rose to 4.6 times at fiscal year 2022. And if you remember when we always discuss this, anytime that number gets above 3 to 4 times, that's where we're concerned. But despite all this, the company and its over 1,100 stores generate over $17 billion in revenues last year. And we don't have any immediate credit concerns. We think they have some time, at least 6 to 12 months, to kind of work out their future. But that future is uncertain as they attempt to find a path forward. The other thing that gives us some relative ease is that there are no major debt maturities before 2025, and they have solid liquidity. So 2023 is being called a turnaround year by management. Strategically, the focus is on managing inventory, cutting costs, improving or simplifying its value strategy, meaning simplifying its pricing and promotions, and being more targeted with regular clearance events to move their slow-moving goods throughout the year. As for store activity, it's been pretty light. They opened 2 stores in the first quarter. They plan for another 5 stores later this year. The other thing that is reassuring is the new CEO, Tim Kingsbury, said all their stores are profitable and they have no plans for store closures right now. So back to Sephora. The Sephora presence is being rolled out to be in more than 900 locations by the end of this fiscal year, including more than 850 of its regular or 2,500 square foot shops and stores. And they've also started to roll out 50 of its smaller 750 square foot shops within existing Kohl's locations. So they're targeting about $2 billion in Sephora sales by 2025. So the chief goal for Sephora, within Kohl's at least, is to bring in a new, younger shopper into their locations. Now, is it going to work? The evidence is questionable, and we can argue this didn't work out so well for JCPenney, but there is some initial evidence that maybe it's doing at least something positive. I'll come back to that point in a second. But last week, they reported their first quarter results, which saw comps fall about 4%, but operating income was up 20% on stronger gross margin. Gross margin increased about 70 basis points. So the end of the year was solid inventory levels. The end of the first quarter, inventory was down about 6% year over year and back in line with historical levels. Still, though, given the current environment, they still could be considered a bit high given the outlook for where they expect sales. And in terms of their outlook, management did reaffirm their fiscal year 23 guidance. That includes net sales declining 2 to 4%, including the impact of a 53rd week in 2023. So that's going to add about 1% to their overall sales. So adjusted for that, sales are expected to drop around 3 to 5%. And then they do expect some back-end loaded improvement in their operating margin to about the 4% range. So operating margins should about double during the year. And again, most of that should be back-end loaded. We did see improvement in the first quarter as well. And looking at the first quarter a little bit closer and bringing it back to Sephora and its impact, management said beauty sales rose 150%. And Kingsbury, their CEO, said, we're bringing in new customers and they are shopping at more than twice the frequency of our average customer, meaning they're coming in more to visit those Sephora shops. So that sounds good, but you could also argue that Sephora is masking an even sharper decline in the core Kohl's business. So it's kind of subsidizing the rest of the business at this point. We'll have to see if, again, these trends should be improving slightly from the first quarter performance, again, when comps were down 4%. And the good news is, as they kind of complete the remaining Sephora conversions, their spending should drop. Their capital spending should drop, and some of their SG&A costs should also roll off. And that'll hopefully set them up for a stronger fiscal year 2024 and towards their long-term goals of low single-digit sales and a 7 to 8% operating margin, so double from where they expect to be in fiscal year 2023.
All right, so next up is CapEx. And on the percentage basis, it looks like it's down somewhat, some of these companies, but I think we've seen year over year CapEx spending increase. Obviously, it dipped significantly during the pandemic as companies were trying to preserve cash and help cash flow. But we're seeing an increase, and I think Mike mentioned this earlier. Most of the CapEx is being spent on IT infrastructure and improving the omni-channel experience, improving supply chain, A lot of companies are focused on reducing time to market. So in the traditional sector, again, without a lot of store openings, there are some IT expenses being spent on fixing up stores, especially higher end stores. But again, the vast majority of this is being spent on infrastructure and improving the supply chain. And there, some of the stress on supply chains that companies didn't know they had surfaced during the supply chain issues and inventory issues. So we're seeing companies focus on that. So cash flow, this is cash flow as a percentage of sales, not cash flow itself. And we saw pretty much record free cash flow in 2021. A lot of it had to do with an increase in operating profits and the working capital impact on free cash flow. It kind of reversed last year with all the excess inventory and kind of tempered down some of the free cash flow. I think this year CapEx spending is going to be up a little bit again, and we're going to see some operating incomes down. Inventory might have a positive impact on free cash flow. Looking at it from a TTM basis, Penny's and Kohl's, and Mike just did a great job talking about all Kohl's issues. We're the only traditional department stores with negative free cash flow. And a lot of Penny's had to do with their inventory issues.
Yeah, we saw last year was kind of a real roller coaster with cash flow in terms of the first half, build up in all those inventory, a lot of negative cash flow numbers. But then by the end of the fourth quarter, as they liquidated all that excess inventory for the most part, they were able to generate some positive numbers, except for the underperformers, JCPenney, Kohl's, and the Hudson Bay banners. So looking at our spotlight on Nordstrom's next, Nordstrom's, we all know, had historically outperformed most of its competitors, but stumbled in recent years with disappointing results, which underperformed the sector and Nordstrom's pre-pandemic trends. Fourth quarter sales fell 4%. EBITDA plummeted on the back of heavy markdowns to clear out the excess inventory. For the full fiscal year 22, sales still grew about 5%, but EBITDA was down 2%, with the EBITDA margin dropping 50 basis points to just 7.7%, again, below the pre-pandemic levels in the 10% range, as the bottom right chart shows. Excuse me. In 2022, management noted customer demand decelerated in late June, continued through the holiday season, and was more pronounced with lower income consumers. The markdowns to right-size inventory pushed gross margin down 525 basis points in fourth quarter and 150 basis points in the fiscal year, which including clearing out older and unprotected merchandise from the rack business. Again, that was underperforming, and underperforming private label brands. The good news was that the company ended the year with a healthier inventory position, was down 15% year over year. As it looks to regain its footing, we've seen a number of executive changes, including the recent CFO departure and the departure of its chief marketing officer. So the new management team is tasked with resetting the underperforming rack business. And the focus there is focused on the top 100 premium brands, which they said represented over 50% of the segment sales. So get rid of and shed a lot of the underperforming brands that they might be carrying in their stores. And then north of the border, the company decided to cut its losses and closed all 13 of its unprofitable Canadian stores and the e-commerce stores. The management said they had lost money in Canada every year since it launched the business in 2014. Thankfully, it's just about 3% of their total sales. Cash flow-wise, despite the operational underperformance, the company generated some positive free cash flow. And they saw its net debt levels fall by about $360 million last year, so they reduced some of their debt exposure. So the balance sheet is stable, and all interest on debt at fiscal year end was a fixed rate. So given the variable rate environment, they're protected. And they only have $250 million in debt maturities between now and March 2027. And liquidity was supported by an untapped $800 million revolver at the end of the first fiscal year. This week, they did report first quarter numbers. So here's a quick update. Sales did drop. They were down almost 12%, including almost a 2% impact from the wind down of the Canadian operations. So excluding that, they were down about 10%. Nordstrom banner was down 11.4%, and Nordstrom Rack was down 11.9%. And most categories in the U.S. are down across the company versus 2022. 2022, though, was kind of an anomaly. We saw the strong pent-up demand and return it to occasions after the pandemic. So they had some pretty good numbers to compare against. Management said the quarter got off to a slow start, but then trends improved, particularly at the Nordstrom Rack late in the quarter. Strongest performance was in April and into the second quarter. So that's a positive trend. Gross margin expanded by 110 basis points as well. Stronger inventory positions meant less markdowns and a stronger margin. Year over year, inventory was down around 8%, so still in pretty good shape there. In addition, the company said they continue to control their overhead costs pretty well. So despite the issues with Rack, it continues to expand the format. During the quarter, they opened 8 new Rack locations, and they announced plans to open 23 more Rack stores through the spring of 2025, most of those in 2023 and 2024. They ended the first quarter with good liquidity, $1.4 billion available, including $500 million on cash and $800 million available under that revolving line of credit. And given the improved trends going into the second quarter, despite the rough start, they reaffirmed their fiscal year 2023 guidance, including total sales declining 4 to 6%. And that includes about a 250 basis point hit from winding down Nordstrom Canada. Operating margins are also expected to see modest improvement, driven by the gross margin gains, especially in the second half of 2023, that more than offset the slower start in the first half. So underperforming, but they seem like they're gaining a little bit of traction on the Rack brands, but it's still clearly in a turnaround phase in terms of getting themselves back into their historical stride in terms of the outperformance of the rest of the sector. So we still have a long way to go as for Nordstrom's to kind of feel comfortable that this is still the company we had pre-pandemic. So reflecting its operating challenges, we move to the next slide, which includes the stock chart. Nordstrom's stock price is traded significantly lower. It's one of the worst performing within our department store sector, down around 40% year over year. Another thing that happened recently in last fall was there was some potential takeover interest in the company, given its underperformance. And the Nordstrom family members, who control about 30% of the common stock, the company adopted a poison pill back then to kind of ward off any unwanted raiders in the company's equity. Other underperforming companies were Macy's, and as Jim mentioned earlier, they reported some pretty disappointing 1Q results today. And again, calling out the higher inflation and rising interest rates that are stressing its consumers. Their comps fell 8%, EBITDA dropped 32%. And that led management to lower its fiscal year 2023 guidance. So investors seem to have anticipated this, as the stock had been trading steadily down since a 52-week high just a couple of months ago to now down trading to a 52-week low in that mid $13 range today. And that's, as of yesterday. Jim or Emily, do you have any other comments on the stock chart?
No, just as you can see, Ross and TJ Maxx are outperforming the rest of the sector here.
Right, and that reflects, again, those sector trends that we've been discussing and how the current environment is kind of favorable. And with that, I'll turn it over to Emily to kind of talk about Burlington.
Yeah, Burlington was the only off-price department store to have a decline in their stock price. So we'll get to that. Burlington didn't do great in 2022, and that's due to a couple of factors. They were coming off a record year of sales in 2021, and they had significant inventory missteps this year. So their inventories were depleted. They had stores with large out of stocks for products that were in high demand. And then they also had a pretty poor pricing strategy. So they decided to raise prices this past year while most of their competitors were rolling out deals and giving promotions. So that move actually backfired. They opened 87 net new stores consistent with what they typically are doing. This year, they do expect to open 70 to 80 net new. So as I mentioned previously, their store expansion plans, some of them have been delayed into 2024 and beyond just because of that lack of real estate supply. Their first quarter results recently came out, and it was better than the fiscal year. However, they weren't quite up to speed with what people were expecting and what they were projecting. So sales were up about 11% with comps up 4%. Management did comment that sales fell off in March, and until mid-March, comps were up about double digits. They blamed lower tax refunds and cooler weather leading up to Easter, which is subjective. They did notice a nice pickup in its trend since mid-April that's continued into May, so that's a good storyline. But they also highlighted they're seeing evidence of a trade down customer in their stores, so that's no surprise to us. Their higher income areas are outperforming the rest of the chain, as you would expect. In terms of liquidity, the company's got solid liquidity, almost $1.4 billion. And that includes about $860 million of their revolver availability. So there's pretty solid ground there. Their debt that they service is about $1.4 billion as well. However, they don't have any near-term maturities, so that is good for them. In 2Q, it does expect sales to be up about 8 to 10%. So in order for them to reach their full year guidance, which they did reaffirm, they're going to have a pretty strong back half of the year. So in order to get sales up 12 to 14%, the back half's going to have to outperform that. Profitability, they expect to improve as they work on their merchandising and inventory mistakes. And that will be driven by hopefully a sales increase. They're also working on their costs with their merchandising and improving relationships with vendors. Overall, I'd say we think Burlington is set up to perform well this year. They have a solid balance sheet, adequate liquidity, and they've also got total debt to EBITDA of about 2.1, I believe. And so that's well below our threshold of 3.5 as a warning sign. So that layered on with the off-price outlook, which is favorable, we expect Burlington to deliver a stronger full year 23 and to be closer in line with their off-price peers.
Emily, there was one question, and I think you didn't reply to. Given the poor worst first quarter numbers, did the company restate its 2023 outlook? I think you said they reaffirmed, correct?
Yeah, I apologize. I didn't see that come through. They did reaffirm their guidance. So they did not pull back on that, which was a little bit surprising here.
I don't know if you could characterize it as a poor first quarter, given the sales increase and the improvement over last year.
Right.
Maybe under their original guidance, but it wouldn't be poor.
Right.
Exactly.
So our next slide just shows your percentage available in your credit facility. And as you can see, most of the companies are in solid shape with 80% plus, providing good liquidity. I think the two companies that we are very concerned with are Saks.com and the HBCX. The brick and mortar Hudson Bay business, they did come out and say they raised an additional $240 million in liquidity subsequent to year end. And we're still waiting on their fiscal year numbers. And then Saks.com said they had total liquidity of about $163 million at the end of the year. Most of that was from under their revolver. So their revolver availability slipped to about 35% at fiscal year end. So they're in a cost-cutting mode, and the company said they're taking actions to preserve liquidity. They're going back to my comment earlier about online. They're making changes to its free and premium shipping. And they also are doing headcount reductions that are expected to save about $20 million and canceling some open positions and reducing their overall marketing spend. Jim's earlier point about the high cost of acquiring online customers. And then, so these are two accounts you certainly want to pay attention to in terms of the liquidity. With the Hudson Bay Nut Company, they have a lot of flexibility in terms of the ownership owns significant amount of real estate, right? And a lot of that real estate is Hudson Bay, Saks, or Saks or Fifth locations. So they could monetize those locations if they wanted to, but in the end, they also want to protect that real estate in terms of the value of that asset as well. So there is some flexibility there. And again, they did just raise $240 million in liquidity recently.
Yeah, Mike, I would say right now the two biggest catalysts for a company filing bankruptcy would be upcoming debt maturities that they couldn't repay or refinance and liquidity issues. So I think in the sector, and you covered it very well with Saks and HBCX, there's some liquidity issues, but they do have options. The other company that we really haven't discussed because it's privately held and we have an NDA and there's not a lot we can put out publicly is Belk. And we have some liquidity concerns with them, especially since they no longer have their PIK option available. They used it all up and they're having to pay cash interest. They made the first cash interest payment in May. There's another one coming up in early August, and liquidity is going to be very tight there. So there's not a lot we can publish on them, but if anyone has questions or concerns, I know we've spoken to a lot of people on Belk. If you want to contact Mike or I offline, we'd be very happy to discuss the issues at Belk.
And then in terms of debt to EBITDA, and again, this reflects both the financial risk and the operating risk of the company, the financial being the debt that they've assumed. Anytime you see this number jump above 3 or 4 times, that's a concern. Obviously, we have the Kohl's issue that we discussed. The leverage ratio is now 4.6, a big jump from the 1.6 the prior year. And again, that reflects increased debt, declining operating profits. But again, we aren't particularly concerned about them. And then, of course, you have HBCX, which very leveraged, low profitability, and a significant amount of debt. But again, we just kind of discussed some of the levers they have to pull to kind of manage their debt profile. And then, of course, there's interest coverage, which again shows us similar trends. And for the most part, you want this higher, above that 3 to 4 times. And for the most part, we're in pretty good shape. Most of these companies, even JCPenney, has a pretty strong balance sheet at this point, despite some of their operational issues and strategic issues that they still need to contend with. And Kohl's was still at 3.5 times at the end of last year as well. And then again, there's HBCX with their interest coverage below 1 times, which essentially means they've got to borrow money just to make their interest payment every year. Just plug that kind of that negative result.
A lot of companies in the sector smartly either repaid or refinanced their debt in 2021, right off their strong year. Penny's, for instance, paid down some debt, moved maturity dates out. And, Macy's has paid down several $1 million in debt. So generally speaking, in this sector, it's in very good shape as far as debt maturities are concerned.
Particularly the off-price TJX and Ross, almost 1,000 times interest coverage for both of those, and even Burlington.
I think both companies cash covers total debt.
Yeah. And then finally, our credit rating, which is just an amalgamation of all these conditions as well as their outlook for the company. And, we did see that upgrade for Dillard's, as Jim discussed previously, their strong performance in recent years. The only downgrade was Kohl's in the last few months. E2 for Saks was an initial rating as we started getting their financial information. HBCX, we don't have comparables, but I would put them probably in the low D range, maybe high E range at this point. Looking forward, given the trends that we see, you could start to see some downgrades, particularly not in the traditional segment with the Macy's, the Dillard's, the JCPenney. I do think Kohl's probably, if they hit their goals, they're probably stable in that D1. they exceed their goals, we could see them back into the C range. So that kind of wraps up our concluding comments. If anyone has any further questions, feel free to type them in, or, obviously feel free to reach out with any of myself, Jim, or Emily. We'd be happy to take your call. We also would like to hear any feedback that you might have on these presentations, so we can learn and do a better job in the future, or even better job in the future with these presentations, so you can get as much value out of it as possible.
Mike, I would just comment on the credit rating side that Belk, is a concern, and on a pro forma basis would be somewhere in the E's, given the information we have. And then missing from here is Boscov's, which we've gotten numbers from in the past. After long negotiations, I think our NDA is finally getting put in place, and we should be getting the financials, and that was rated C1.
Okay, doesn't appear like we have any questions, so we want to thank everyone. Looking forward to talking with you all in the near future. Thanks again.
Thank you.
Thanks, everyone.